Hi, everybody. Our topic is, again, the state of the industry. And we see, on the one hand, that there is a lot of dry powder and new funds being raised on daily basis. But I just saw the new Crunchbase data, which says that only $25 billion were raised by startups in August, which is the lowest in 2 years. So we understand that something is going on, and that's our challenge, to understand here on the stage where are we going, what's really happening, the recession, no recession, slowdown. And I will start with the ladies on the stage. Whitney, you have vast experience, you saw downturns. What advice can you give the founders, the young founders, how to deal with this new challenging situation?
Yeah, thank you. I think we've heard a lot today about companies looking to be smarter about the decisions that they make as founders and how they invest their money, maybe take a slightly different position, maybe a more conservative position on cash spend. And so I think those are things to be wise about. But I think some of the best advice we've heard today that I would repeat and underscore is that founders today really need to focus on how do you move the needle with growth without doing it at all cost. It doesn't mean that you have to be efficient to the maximum benchmarks, but it does mean I think you want to be more, just more thoughtful about how to make sure you're investing in the things that move the needle and drive growth. And those companies are going to continue to have funding, continue to get support, and continue to kind of see the kind of growth that maybe we wouldn't have seen 6 months ago, but we'll see again in the not too distant future, I think.
How in Insight, which is one of the largest in Israel, you are a very active fund. How do you coach your founders? You tell them what to change in their routines?
Actually, I feel like the last 6 months or so have been one of the most rewarding times as someone who sits on the boards of our companies, because many of these companies haven't seen a downturn before, and they don't necessarily know exactly what to do, how best to do it. And so Insight, we invest a ton of resources in people like myself who've had 30 odd years of operating experience, a whole bunch of other operators who are there to give guidance, to give best practices, to share benchmarks of what others are doing. And I think that we're in a great position to just sort of help people weather the storm and to come out the other side as well poised as possible to be successful. And so I think that's actually been really rewarding to help these companies navigate what is not necessarily an easy time.
Do you think that you will close some companies during the road?
I haven't seen any yet. It's certainly not impossible that we'll see some companies not make the downturn and survive the other side. But I would say the vast majority of our companies are very well positioned. And again, we're here to help. So if we can give them more resources, whether that be financial and or expertise, then we're really helping them to kind of set them up for success, not just in the near term, but in the long term. And that's really, I think, what matters.
Okay, thank you, Merav. When we speak about the industry, we mostly focus on the company, the product, the employees, and sometimes we forget the founder, which is for him, for her, is a very stressful time. And how do you think this can affect the startup, the potential success?
Hi. So funny that you ask, or maybe you asked because you saw that 2 days ago we launched some initiative, our fund, State of Mind Ventures. We launched an initiative called the Wellbeing Initiative. This is something we've been working for a while, way before this downturn, but I think it's even more relevant now. So I think we tend to think about things in a very linear way, but the state of mind or the well-being of the entrepreneur is definitely not linear. And there's so much pressure on the entrepreneur. I mean, they carry the pressure vis-a-vis their employees, their customers, their investors, their families who obviously, don't see them quite often. And yet, there's not a lot of talk about the well-being of the entrepreneur and how crucial it is for the success of the company. So we've been dealing with it on a one-to-one basis, mostly with our entrepreneurs for a while now, but we've decided to launch a large-scale survey to better understand, where, our industry is at, where the entrepreneurs are at, and kind of try to find tools and guidance for them to better their well-being and take care of themselves so they can actually take care of the company. And when I say well-being, it's do I get enough sleep? Am I eating well? Am I exercising? Do I laugh enough? How is the state of my relationships, and is it helping me to be a better leader? So we launched a survey with Get Wiser with about...
Have the results by now?
So we have some results, very, very initial, but we're going to launch it for the entire industry. So stay tuned and please, send it to your entrepreneurs, because we really want to, understand this, more in a deeper way, and we're going to, of course, provide back the tools for the entire community.
Okay, Barak, now I'd like to turn to you. Being a founder is a lonely, sometimes is a lonely role, and sometimes people prefer to merge, especially with given the current situation. As a lawyer who specializes on M&A, give us a couple of thumb rules when it's the right path is to go to the M&A.
Well, I think there's no one answer to that. I think it really depends on the company, its syndicate of investors, assuming it has investors, its field. And I think, honestly, it's not a decision that the founders should make by themselves. It's a decision that the founders should make together with their board of directors. I do think, though, that if you look at the economy today, it's much harder to raise money. Obviously, valuations are not what they were, at least temporarily. And so there are many companies that are, for either voluntarily or for a lack of alternatives, looking at being sold. And as a firm, we've had the great fortune of working on many of the largest transactions in Israel, Mobileye and Move-It and Tower. But I can tell you that we've also done many, many, many small deals, and many with distressed companies. And those transactions typically are much more difficult than the large multi-billion-dollar transactions, because you have a group of shareholders who aren't necessarily real motivated to sell, who are certainly not motivated to take on any type of liabilities. And so for those companies who are looking to be acquired at this point, I think it's more critical that they come up with a roadmap before they even start the process with a potential acquirer. The roadmap being sitting down with their board of directors, figuring out together with their service providers, accountants and lawyers, and if they're working with bankers, how to get this done. How is it going to work? Where are the red lines? What are they willing to compromise? Where are they not willing to compromise? How is it going to work? What's the financial incentive for their shareholders? Because in some of these distressed companies, not all shareholders are going to receive consideration. And so I think if they're able to accomplish that, their odds of going to a successful M&A are much higher.
Okay, thank you. And speaking of difficult stages, Yaron, I would like now to ask you a question. You present here Elron, which is, we can say, the oldest VC in Israel, even before we had the name for that.
Most veteran, let's say.
Veteran, yeah. Seasoned, okay. So you see lots of companies. What stage is the most difficult today for a startup? When you face this kind of wall, you have to just jump over.
Yeah, I think first it's difficult in every stage, obviously. The valuations that were there last year and the mega rounds that we saw make it, I don't know if impossible, but harder to raise another round in a higher valuation. And it's obvious. And I think the common phenomena, as Whit said, that companies are more cautious with spending and extending their runway in order to avoid setting valuation. And given the fact that, FOMO is not really here as last year, so it makes it even harder. But specifically to your question, I think the common answer that you will get is that A round is probably the most difficult one. But I would say the outcome of that is that seed round is really problematic right now. And we see decreased number of seed rounds, as you mentioned, TechCrunch, I'm sure we all going to see it. And the reason is that, as mentioned, last year, to raise an A round, it was sufficient, at least in the software space, to have 2 converted design partners into clients and a nice MVP, and you will have an A round very easily. Nowadays, you're probably looking for, the A round leaders probably looking for a double-digit number of customers and clear product market fit, which requires obviously additional runway and additional funding. And the A round obviously is being done in decreased valuations compared to last year. So the seed funds are seeing it and understanding that you need 24, maybe 36 months to get to the A round goals, meaning you still need those sizable rounds, seed rounds, in order get there, and you won't do it in a decreased valuation because then you'll dilute the founder and it doesn't make any sense. So I think that the early stage ones are being more cautious and
okay, and we have here Pavel from Hetz Ventures, and they're seed investors. So when was the last deal of your fund?
Yeah, so I'm from Hetz. If you don't know, we manage $300 million in Israel, now investing out of Fund 3, $120 million. So we've done last investment a month ago. The company is out, working. I totally agree with a colleague of mine here, kind of saying that today, so what we see that the numbers are back to 2019, in a sense that companies, they're still able to raise its seed. Seed is not dead. We actually think that's the most interesting.
Not dead at all.
Maybe I'm a bit biased, but I do think seed is the most interesting stage to invest right now. There's going to be plenty of opportunities, and they're still happening. We tell the founders, you'll have to achieve way more with the same amount of capital or a bit less. The KPIs for Series A, they've increased a lot. So there used to be a term last year saying logo velocity will be sufficient to raise Series A. So there is no logo velocity anymore. You have to show actual top line. Yeah.
Okay, and Sal, Merav, you want to?
I just want to add to that seed rounds might be smaller, and then but probably the cost will not go down because we're still missing 14,000 engineers, right? So probably the salaries will not go down considerably. So you have to achieve much more with less money for longer time. So capital efficiency.
And paying the same money to the engineers, you said. So Sal, at KPMG, you see the whole economy, you meet the companies. What do you feel on the ground? Is there a real recession? All those startups, they have to sell their product to someone. Someone has to buy it. What do you see in the market budget-wise?
Well, I mean, a lot of the points were already hit on. I mean, the IPO market's effectively dead compared to 2021 levels. But there are companies, getting funding. There's a lot of, you mentioned the dry powder and so on. And I think the investors are looking at the companies differently, right? We're no longer in the days of showing top-line growth and being able to, raise a significant round. I think the investors are asking for, what does the road to profitability look like? I mean, they don't necessarily require the companies to be profitable, but they at least want to see, what is the path? Are you able to control costs? Are you able to control headcount? And with that, you're seeing a lot of, continued funding of private venture-backed companies. The funding comes with, whether it's flat rounds, whether it's even down rounds. But the funding's still occurring. So, when this is going to end. No one knows. I left my crystal ball at home, but some people say there will be a window of IPOs in 2023. The window may be small. It's going to open and close pretty close.
Why there will be a window?
It's what the smarter people than I have been telling me, in talking to the VCs and so on. They think that there will be a little bit of a simmering down of the geopolitical kind of issues that are inadvertently hitting companies unwarranted per se, right? So companies and investors are not looking to rush out with an IPO just to get hammered by a market by factors that don't even impact their company. It's just the environment we're in. So if there is some simmering down of some of the geopolitical and other factors out there, there might be a window that companies will try to list. Like you talked about, at KPMG we serve thousands of venture-backed companies. We have a lot of perspective in what companies are looking to do, and there are a lot of companies that are ready, and they have their draft filing documents in with the SEC, and they're just looking for the right time to pull the trigger. And in the meantime, I think what's happening, at least companies that want to take advantage of this are doing, is they're actually preparing themselves a lot better. They're beginning.
You have more time.
Yeah, they're actually beginning to operate like public companies internally before becoming a public company. And what do I mean by that? Closing your books on time, doing draft MD&As, doing mock analyst calls and things like that. So I think when they do go public, they're just going to be that much more prepared.
Okay, so let's open a bit for a discussion. Would you start a new company now in these days, or it's too scary? Wait.
Here's the thing. Founders are some of the most fascinating people because they have this idea that they feel compelled to pursue and a problem they feel compelled to solve. And there's this crazy amount of faith and belief that founder has to have in him or herself to go and do that. And I don't see that energy lessening at all. So I think the pace of innovation is continuing to be fairly rapid, and we're seeing great opportunities to fund and invest. And to the earlier points made by several of my peers here, I think, for Series A and later, the criteria has gone up, the bar has gone up, but the opportunities for investors to invest and the energy of founders to continue, I think, has not really lessened in any way.
Barak, do you see more new companies coming? Some incorporation?
I mean, I don't think we're feeling it right now, but I expect to feel it. I mean, the reality is, even though things have slowed down, there are a lot of venture capital funds sitting on a lot of money, and the money needs to be deployed. They cannot just sit on it indefinitely. They have to invest it and generate, or do their best to generate, returns for their investors. So I definitely expect that the pace of investment activity will increase. And I think if there's a founder who has a passion and an idea to start a new company, I would certainly not encourage that founder from doing so.
Yes, Yaron?
I think that I totally agree, and if you're founding a new company, I think as opposed to last year or the previous years, you really need to be focused on the product. I mean, the niche solutions, or AKA as the feature product, will not get funded anymore. You must think of a platform, of a problem that needs a wide solution that will be able to get wide adoption. And for those companies, I agree with Pavel. No doubt that they will get funding from the seed rounds.
Merav, and then Pavel, which sectors do you think are better now, more resilient to this recession, and there would you prefer to invest?
So I would say, connecting to what my colleague said, that as VCs, we are not day traders, right? We invest long term in the fundamentals, and the fundamentals are tech is here to stay and to grow, and it's always going to the right and to the right up corner. So, and our kids and our grandkids will live in a very different world than us. So this is going to continue. And entrepreneurs that are real entrepreneurs, it burns in them. They're going to do it anyway. I think, if I think about it in a structured way, I think if you look at the Maslow pyramid, the higher you are, the less likely it's very relevant in a recession time. But cyber is still something we need, and with the geopolitical situation, even more so. I think Israel has a good opportunity in terms of food tech and agro-tech. We have a lot of innovation in that area, and this is here to stay and to grow. Same thing as to climate change.
Yeah.
I think.
Sal, would you like to?
I mean, the only thing I would add on there is we're seeing a lot of activity. I mean, cyber's, white hot there, but logistic tech or supply chain tech are also areas that, out of necessity, quite frankly, are emerging and getting a lot of attention as well.
Pavel, do you focus on certain sectors?
Yeah, so we do focus on specific sectors. And actually, I do with Yaron. Nice to have solutions. Won't get funded these days. So we very much focus on, is there a budget within an enterprise that kind of dedicated to a specific kind of a potential product? We focus today, as we used to, cloud infrastructure, DevOps, DevTools, cybersecurity, data. I think they're less affected, at least for now. We're monitoring closely kind of the quarterly reports just to see, and we're speaking with our network kind of C-level executive, just to understand how much and what they're going to cut in their IT budget. I think we will see more of that towards the end of this year. One trend we also see kind of no one really wants to onboard feature product. So kind of at this point solution, new vendor, it's always a question, we're going to be within the stack. But yeah, we still remain very bullish on those sectors.
Now, a question for the VCs. Over the last years, we saw in Israel a huge activity of foreign funds, American funds, and which are often crossover. They don't mind. They don't focus on a specific stage, and then they went early and earlier. Do you feel now it's easier for you to operate? Less competition on the founders?
So actually, we've partnered with our US-based VCs from the seed stage. Just kind of an example. So with our friends from Insight, we have 3 companies. One successful in Granulate. There was a good outcome. We partnered with Insight at seed. We actually feel there was a very good round. So there is a competition. I think if you are an Israeli-based fund, you speak Hebrew, you are in Israel, you have good access to deals, you should be fine.
Yaron?
And I think it's no longer the case where the Israeli VCs are investing in technology, in developing the product, and then the US VCs are taking care of the go-to-market. I think there's much more synergies here. I agree with Pavel. There's the US VCs coming to invest earlier is an opportunity for us, and we also at Elron partnered up with a few of the US VCs in the seed stage. I think it makes the culture of the company for the founders to understand what's going on in the US, what's going on in Israel, and it's better to start a company this way.
Barak, do we see more, like I hear, but I never saw it by myself because it's a huge secret in the industry. Do we see more different term sheets? Do we see more small letters, safes, ratchets, and stuff like that?
Yes and no. I think what we are seeing is definitely a lot of VC-backed startup companies that are looking for alternative financing solutions. One of which we've seen a lot of traction in is venture debt. So this is an opportunity for the company to bring on a line of financing without dilution. The idea being that it will kind of allow them to bide their time until market conditions change so they won't have to face a down round. We are seeing a number of the venture debt lenders come up with somewhat more aggressive terms. On the equity side, Yes and no. I think a lot of the traditional investors are not looking to kind of change their traditional investment strategies and insert full ratchet anti-dilution protections and multiples on liquidation preference. On the other hand, we're seeing other kind of opportunistic investors who are coming in with those more aggressive terms.
Okay, to conclude this discussion, I have to ask you, Whitney, I heard that you also invest in restaurants. So the bottom line is, which is more riskier, restaurants or startups?
Oh, restaurants by long shot. Personal investment only, not speaking on behalf of Insight. I invested in a couple restaurants. There's a long-standing phrase that if you want to make a fortune in the restaurant business, if you want to make a small fortune, start with a very large one. I think that's probably true.
Okay, so stay in the tech. Thank you very much, everybody.
Thank you.